Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Standard Chartered Money Insights. My name is Marco Iachini, and I'm a cross-asset strategist from the CIO team. On today's episode of the podcast, we'll give you an update on 3 key signposts that we flagged earlier this summer and implications on value equities. Lastly, we'll give you some perspective on the recent sell-off in gold. Joining me today from this conversation, I'm glad to welcome Steve Brice, our Chief Investment Officer. Without further ado, let's start today's conversation. Steve, we talked about earnings, economic and monetary policy, and COVID trajectories as 3 key signposts to watch this summer. Can you give us an update and tell us more about their evolution so far?
Yeah, so thanks, Marco. And so let's go through them one by one. So obviously on the earnings perspective, that's been unequivocally positive for asset markets. So in our 2 favored markets, for instance, the US and Euro area, we've seen an outperformance. So earnings growth expectations were already very strong, but US has outperformed those expectations by 16% so far. And the Euro area is 22% above those expectations. So we're seeing a very sharp increase in expectations for H2 earnings expectations as well. So overall, it's been very positive from that front. In terms of data and policy, just some things that's happened over the past week. I suppose in the US, we've seen the jobs report remaining very strong. Initial jobless claims have continued to fall. And actually, quite importantly, inflation is showing some signs of peaking as we expected it would do. So particularly if you look at it on a month-on-month basis, July inflation did see a significant deceleration. So we are looking for that to be a strong growth and relatively modest inflation environment, which is good for asset markets. From a policy perspective, obviously on the fiscal side, we had the $1 trillion infrastructure bill being approved by the Senate. We wouldn't actually overplay this. It's not that material in quantum, and also it still has to pass through the House. And I think more important is going to be the $3.5 trillion budget bill that the Democrats are going to table in the coming weeks, because both are tied to that actually. So we need to see that come through. But overall, it's still better than we were a couple of weeks ago. On the monetary policy side, this is where people may be getting a little bit edgy, but we would see this as largely as taking the foot off the accelerator rather than hitting the brakes. So obviously, we've seen Fed officials coming out saying that they are getting increasingly positive around the environment, and that means that maybe they could taper earlier than expected. Our sense is we're still going to see tapering coming through in Q1, but normally that doesn't really affect asset markets until we get to constraining monetary policy, or when monetary policy is tight rather than still loose. And to get there, we need to be at least 2%, above 2% interest rates. And obviously we're a long way from that. So overall, the earnings data, economic data and policy is still very supportive of risk assets. The one area obviously that, is very mixed is the COVID trajectory. So we mentioned a few weeks ago that the UK experiment of vaccinate and live with it is really, really important to see how that goes. On the positive side, we've seen hospitalizations tentatively peak. It's weekly data, so we only have one data point. So obviously we're going to be watching that very closely. But if that has peaked at much lower levels than we've seen in previous COVID waves, that would obviously be a very big positive for this idea that you can vaccinate and live with it. Negative side, we are seeing cases accelerate again in the UK, and obviously we've got concerns now in Israel, which is vaccinated pretty well, and also China, which is going along that vaccination route as well. The only caveat I'd say to those concerns is, we were talking before the Delta variant came through that 70%-ish from a vaccination rate was probably required to achieve herd immunity. Only 3 countries, according to the FT tracker, have actually hit this so far. So from that perspective, we still have some way to go. And obviously, the Delta variant could say that actually needs to be over 80% now. So this is likely to remain a key uncertainty as we go through the rest of this year. Obviously, that's in the developed world, but especially in the emerging world. So we have something we need to keep an eye on. But overall, we're still constructive on risk assets given the balanced view of the factors we've just gone through.
Thank you, Steve. That was very thorough. Now, one more topic I wanted to touch on is that of value equities. We have a current outstanding theme of value rotation, and we saw that we gave up some gains during Q2, but it looks like perhaps that the tide is starting to turn in favor of value again. What can you tell us?
Yeah, maybe just very quickly review the thesis for our preference for value. So basically, we saw a very dramatic underperformance in 2020, and our view was that as growth, inflation, and bond yields rebound, then we're going to see value recoup a lot of those losses and underperformance. That worked in Q1. We've seen some weakness in Q2 and more recently, but overall, we think that tide is starting to turn. The 10-year bond yield has started to move significantly higher. And also, if we look at the technicals, we saw a significant rally in value, both on an absolute basis, but also from a relative basis this past week. And market positioning suggests that growth areas may experience some consolidation or pullback in the coming months. We've seen some what we call market diversity is declining, which means that it's becoming a more crowded trade and therefore is unlikely to extend dramatically. So therefore, we continue to favor value. What does that mean? It means we like financials and energy, for instance, over growth areas of the market. From a regional perspective, it means that these are supportive factors for the UK and Euro area, which we believe are likely to outperform alongside the US over the coming 6 to 12 months.
Thank you, Steve. One last question before we end today's podcast. It's on gold. We've seen gold move quite erratically or in a more volatile way, responding to the recent economic data and policy talks. Now, is it time to buy the dip, or what's the picture here, long-term versus short-term?
So from a sort of 6 to 12 month basis, we still think gold is valuable from a portfolio diversification perspective. We have it as a core holding, which basically means that we expect it to perform broadly in line with a diversified allocation, delivering positive returns. In the short term, we see 1700 as being key support, and we see dips to around this area as being a buying opportunity. So the sell-off in Q2 of this year also fell to similar levels. And if we look at the drivers of gold, two key drivers that we have are real yields and the dollar. So if real yields remain very low and the dollar weakens, as we expect, that's generally supportive of prices. We've seen some divergence in that perspective. But given the fundamental backdrop and the technical support, we think a buy and dip strategy is probably optimal at this stage.
Thank you, Steve. That is all for today's episode of the podcast. Thank you for joining our conversation. If you'd like to learn more or read our publications, please visit our website at sc.com under Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcast. Thanks for joining us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.